Hi, I'm Chuck DiVencenzo, President and CEO of NAFA. And today I have the pleasure of introducing Branislav Nikolic of the Index Standard, and we're going to talk about indexes today. But first, I want Branislav to introduce himself.
Hi, thank you, Chuck, for having me. My name is Branislav Nikolic, and I'm head of the insurance at the Index Standard. Our mission is to help industry participants, be that carriers, distributors, agents, and end consumers, understand better indices and index choices in fixed annuities. And how we do that, we do it through a use of a simple language. We provide ratings and forecasts for indices, and we also provide net forecast credits and a model allocation for fixed index annuities. So we are extremely happy to be here because our mission and NAFA's mission align almost perfectly.
And Branislav, you've been a partner of mine for several years with the different education initiatives. And as you know, NAFA is, we're really big in advocacy, obviously, but our other pillars are integration, which is working with individuals that are members, as well as education, which is so important in terms of understanding the dynamic of both retirement products and income products for our both the agents and consumers. So really appreciate having you today.
Thank you.
So Branislav, you and I have discussed different things over the course of several years where we talked about these indices. And you know, when we discussed this, we were looking for some foundational underpinnings. How did this come about?
So, as I said, we are delighted to partner with NAFA on this educational side, as that's part of our mission as well, to help demystify and make conversation about indices at all three levels of the annuity chain easier. So what really kind of inspired this is that over the last few years we had a massive growth in options available, both in individual annuities as well as in the whole market. So we went from handful or a dozen indices being used for a long time to now over 100 or so indices being sold with the new money at any given time. So we wanted to start having the conversation, but it was important to lay some foundation. We wanted to have some basic terminology straightened out, and we wanted to cover some basic concepts in these first two pieces so that as we progress with the educational series, we can build on it.
And that's perfect. We want something foundational that we can get both agents and then end clients to be able to build around that in terms of the understanding of this sometimes complex business. You know, Branislav, we see folks as they near retirement, and particularly folks, they've been involved in 401ks and IRAs and the like, and they've grown up on index investing, you know, passive investing over a long period of time. So now, you know, we see all these indexes and FIAs. How does that differ, in a sense, in an insurance product versus what you're looking at in your 401k or your mutual funds or your IRA in terms of the dynamic of what these indices provide?
This is a very important question in my mind, and to me it's more important to talk about differences of these than actual similarities, because when you think about index investing in an ETF, when index is created for an ETF, it usually is created with a specific objective. It has a clear benchmark and how you measure the performance. When you wrap an index in an insurance product, that's less obvious. There is no actual benchmark. There is no actual thing to measure the performance against. And more importantly, going a little bit technical here, you are not actually invested on an index or in the assets that the ETF holds. In this particular case, through the insurance product, insurer just guarantees to give you the credit based on the movement of an index. So it's slightly different. If ETF is well built, it would basically track its index, try to track it as best as possible, but ultimately you get both ups and downs of it. Whereas if you wrap this in an insurance policy, first of all, you have accrediting strategies that we've discussed before that are determining how the index performance goes into a math equation to credit interest. And then insurers are guaranteeing that they'll actually just do the math for you. So you're kind of two steps removed from the assets that are governing the index. And it is important to understand that. The second bit is, how do you measure performance of an annuity? These products in general are built to yes, help in accumulation, but a lot of it goes onto the income side of the equation as well. And that's not as obvious to benchmark as it will be, for example, for a passive investment like an ETF. There are a lot of these ancillary benefits that you get through annuity that are not as easy to measure as a performance of an index itself.
And particularly the most important one, which is the limited volatility and the floor itself, where you do not actually lose money on the specific ETF.
Exactly. So it's important to understand that with insurance products such as FIA, you have that principal protection, and that's something that it's not easily evaluated or benchmarked against the assets that are underpinning the index.
You know, as we discuss this here, you know, just curiously, what's an index?
Yeah. I wish Lawrence or Jay were here to talk more about what index means to an index person. I'm kind of a second-hand provider here, but I'm the annuity person, and I think a little bit more aligned with your members, and annuity consumers. And to me, index is nothing but a combination or compilation of the prices of the assets that's tracked through time. So you have the rules. It's important to say that indices are rules-based, that they are, in most cases, algorithmic. And as such, they're nothing more than just aggregated prices of, let's say, basket of assets that you follow. Based on the prescribed rules, you put a mix together, and then you do that through time.
And, you know, we talked about this a little bit early as the dynamic goes on, is that we want to make sure zero is your hero. How does that work in terms of you know, how that plays out for our end annuity consumers? Yeah,
so zero is your hero holds regardless of what index you put into a product. That could be a benchmark, it could be a multi-asset index, it could be a volatility control index. You still have that principal protection that comes from the annuity guarantee. And then the question is, how do you get exposure to the returns that are linked to the index? And they could be slightly different depending on what type of index you have in your annuity.
You know, Branislav, so many folks are visual learners or learn through analogies, particularly with complicated topics. How did you come about understanding the dynamic of how we could do this with this particular topic?
Yeah, that's an interesting question. So we wanted to take a highly technical topic and make it fun. And the only way to do it is to go back to the analogies that people like and something that's close to their heart. So we tried to use very simple and intuitive language. We tried to supplement that with nice, colorful graphics. And we wanted to have like memorable illustrations as well that people will take with them in making these analogies when they're having these conversations with their clients, or when they're training others on how to have these conversations. We thought of doing this in a factory, we thought of labs, we thought of kitchens, and then somehow barbecue struck the chord, because that's something that almost everyone likes to do, likes to go to barbecue, and everyone likes to eat it. So we wanted to stick with a proper burger.
Yes, this recipe idea, which I really loved, because there are so many different recipes. I love barbecue. So tell me about why and how that works.
Yeah, so we wanted to overemphasize the fact that index creation really takes so many steps. And at the end of the day, it really felt like the analogy worked true, because you can start with your ingredient selection. You can figure out ways to mix them, ways to cook them, and then ways to serve them. So, and again, you have different types of restaurants. You can have your fast food joint, you have your local bar, you can have a high-end place. But at the end of the day, the process is the same. You have to understand what your objective is, who your audience is, or who's gonna be your guest at a restaurant. And then you have to go through all the process of ideation, testing it out, trying to see whether you can source the ingredients, how you can mix them together, how you can cook them. Are you able to sustain that over a long period of time? And ultimately, you have to be able to have a test audience, have someone to critique it, someone to vouch that you have done everything that you're supposed to do before you put it on a menu in your restaurant.
So let's get into this. Okay, so trying to understand the dynamic of this, understanding the development, right? So we have various types of return, we have index flavors, and we have risk control.
So let's go one by one. So if we talk about various types of returns, this is a very important topic because in our industry, I don't think there is a good differentiation between these. And when you put the product into an insurance wrapper, it makes a world of difference. So the first thing that I would like to kind of talk about is the difference between price return and a total return index. Price return is the one that tracks the prices of an asset, but excludes the potential dividends. Whereas with a total return, you get those dividends included. So it could be a huge difference between the index level and what you get paid off through an annuity strategy if the index is price versus total return. In addition to that, both of these could be excess return. And this is where most of the indices in annuities really are. And what does the excess return mean? It means that you get the return above the borrowing cost. And again, we were in a very long period of low or zero interest rates, so it wasn't a topic to be discussed. But in today's environment, this is a significant barrier the index has to cross in order to start seeing positive returns. So you have to think about excess return index as investing, but with a borrowed money. You only get the return after you paid the money or the borrowing cost back. So Chuck, when we talk about index flavors, as we said, there was a proliferation in indices over last few years. Prior to that, people were used to seeing only what we call benchmarks inside annuities, and they're really meant to measure the performance of either a whole market, sector of the market, whether that be industry or geographical, but they're really there to measure the performance, and then the annuities were crediting based on the performance of that benchmark. Okay, the next thing I want to talk about are sector indices. Whether those are financials, technologies, auto industry, choosing a smaller sector of the economy to focus on. And then lastly, we have the proliferation of the thematic indices, where you have certain themes, whether that's artificial intelligence, cryptocurrency, something that is currently in trend, and something that we're trying to pick up on the upside as underpinnings for an index. And then lastly, you have asked me about the risk control. So risk control feature is a concept that could be wrapped around any type of index, be it benchmark, be it the multi-asset, total return, price return, excess return. And it's really working on a very simple principle that it toggles between risky and riskless asset. When the volatility is high, above the level at which index is promising to be at, it will de-risk itself and go from the risky asset onto the cash-like asset, and vice versa. When the volatility starts coming down, it will move money from cash into the risky asset. Why is that important? Is that we've experienced in the market that when the prices tend to go down, the volatility is high. So we want to get out of the risky side of the portfolio as quickly as possible.
So another big building block is exposure. How does that play out?
Yeah, so this is a tricky one without getting too technical, but I'll think from a point of view of the annuity buyer or agent who is selling this. So there is a misconception that when you buy an annuity, you're participating in the market, and this cannot be further from truth. Like, you're basically giving your money to the insurance company to invest in their general account and give you the credits or interest credits based on your money. That said, they can choose to offer the exposure to different indices. So if we try to compare that to, let's say, ETFs that we discussed earlier, ETFs are meant to track the index to best of their ability, and with that you get almost one-to-one exposure to what basket of assets in the index is doing. You can gain, but more importantly, you can lose money. When you're in the annuity structure, because zero is your hero, you are getting the formula that's based on index performance. And you're not only getting reduced exposure because someone has to pay for the downside, but you also sometimes, if the risk control index or multi-asset index is involved, you're getting reduced exposure through that mechanism as well. So you could be easily 2 degrees from the actual assets, but by no means you own any physical assets, and you are actually relying on the insurance company paying you the credits based on a formula they have promised they will do.
So in the first piece, we looked at the development of an index. And part of that is trying to understand the thesis and then how it plays out over time. How does that work?
Yeah, so the most important thing is to think about thesis or the objective for an index. And we've hinted on that as well as like whether this index will live inside an ETF or it will go into an insurance product. Now, going back to thesis, it's important to have sound backing for it. So usually people will go to academic research and go to some tried and tested methodologies, whether that's value investing or whether it's investing into companies with a strong and growing dividends, or if you want to choose the stocks that have low volatility. All these go into consideration at the beginning of your thesis or how you're going to select your assets for index or your ingredients for what you are putting together in your basket.
So one of the things that we look at as we go through this process is testing out a thesis, right? And so part of that is through back testing and understanding the dynamic of that to prove out a theory. So, but there have become some issues with back testing. So can you explain how that process works and then what the issue might potentially be?
Yeah, absolutely. So backtest on its own is a natural step in progression. You come up with a thesis, you come up with your rules, you come up with the ways to assemble your index. You need to have a sandbox to test it. Now, the same is true for annuities. We, in our industry, rely on illustrations. That illustration helps us basically show how the annuity works. And it's really easy to do it on something that already happened. People understand how something evolved in history, and they are able to understand arithmetic a little bit better when you have a concrete example. That said, if you use the backtest for an index or a backtest for an annuity as prediction of the future or something that would set expectations for how either index or annuity would perform, this is where we start having the problems. Moreover, we start seeing that because there is this benefit of hindsight and knowing how this is going to be used, some of that backtest at index at both at an annuity level starts feeding back into index design. So we have indices that are now very well optimized to work well in the past, to show that they would have done really well, but they have a potential or falling flat and not performing so well in the future. So I think that going back to backtesting, it's a natural thing. It's how you test your thesis, but you should not readjust your thesis based on what the backtest is saying.
And I think the other thing that's interesting about that too is that there may be a situation where it does repeat itself, but we don't know. And so therefore how that plays out is very, very interesting to me into saying, okay, it's all about the explanation and where this is, and that past performance doesn't indicate what's going to go on in the future.
Exactly. So history will not repeat. It may rhyme from time to time, but the key is that backtest or illustration for the annuity really serve this very important purpose of demystifying the arithmetic that goes into the calculation, but it should be taken with a grain of salt when talking about that as the expectation setting mechanism or prediction of the future.
So Branislav, as organizations develop these products and we go through the understanding thesis and so on, how do they look at the ingredients and then ultimately then select them and work the whole scenario before it gets on the menu?
So that's a very important question. We can go all the way from the, let's say, insurance company that's trying to offer diversified menu of options within a single annuity. So they want to have indices that are different in nature. They can guarantee different types of returns in different environments so that you diversify within the product. But if you go back into index creation, I think it's really about following the process again, going back to the thesis, proving it out, making sure that it has a sound backing, then understanding and finding the ingredients, making sure that they're what we call tradable, that are readily available, and that we can measure them in accordance to our thesis. So if, for example, we are having an index that's a low volatility index, in other words, picking the low volatility stocks, we have to determine the measure of volatility or our uncertainty around the stock price. If we are looking into high dividend stocks, what are the metrics that we want to use? Do we want to look forecasted dividends or we want to look history of dividends? that really comes down into now how do you measure and mix your ingredients. And ultimately, you have to test it out. And this is where we go back to trying it out in different scenarios and seeing which mix works the best, and then giving it to others to try out. In other words, if you're building this for an ETF, will they be able to trade accordance to your index rules to track your index, and what will be its closest benchmark to measure its success? Or if you're putting it into an annuity, the important consideration is that you have to have a counterparty that will be willing to provide you with the derivatives, with the options that would enable insurance company to offer different crediting strategies that we've discussed in the past. So once you go through all these, then the index, so to speak, gets on the menu, gets launched, and then from that on is just simply a calculation of the price of the basket of the assets that you have underpinning it.
So we look at the understanding dynamic of this menu and the building blocks and so on. So how should an advisor use this in terms of understanding it and then ultimately working with the client with it?
I think this is a very important question that arises in practice. And we've heard from advisors plenty of time that indices are not their preferred topic of conversation because the conversation can lead everywhere. It's a highly technical topic. So we really wanted to lay down a nice technical foundation that we can reference back and then pick off topic by topic of what we hear here in the market. So we wanted to give everyone a better understanding of what the process of index creation is, what different types of indices exist out there, how to talk confidently yet in a very simple and straight-through language about these concepts, and what are the implications of having one of these in the policies that they're trying to sell. We plan to dig a little bit deeper on a go-forward basis and kind of explore each of these topics that we kind of just mentioned in the first two pieces in a greater depth.
And that comes to the next question, and probably our final question of the day. So we just discussed, how the first two pieces interacted, how they worked, the nomenclature and the understanding and the dynamics, and also how an agent takes a client through the whole process from, accumulation through retirement. And we want the idea of an agent being able to go through that whole lifeline with the client because it's very, very helpful to them. So how the dynamic of the next couple pieces, we kind of listen to the agents and what they need. So tell me how we might work through that process with the next couple pieces.
Yeah, absolutely. So with the first couple pieces, we really wanted to lay a solid foundation of the nomenclature and adopting very simple, straightforward language that could be used by advisors on the ground. We also wanted to give them some facts about indices, how these come to life, and more importantly, how they're wrapped in the annuities. Now, I think in the next few pieces, we really want to focus on some of the details of, let's say, volatility control. How do they compare, or are they able to compare different indices with different volatility control levels? What does it mean to have certain level of volatility control? On the other hand, we also want to be able to help them understand the benefits of diversification, both at a portfolio level as well as inside the annuity, where with a wise choice of many indices or many crediting strategies, you can actually create that good in-force experience where the credits are coming at a certain pace and the annuity is actually doing what is promising that it will do.
Well, we really look forward to this, and I love working on it too because, again, our NAFA's education initiatives and the things that we like to do, and again, thank you for listening, and we really appreciate you. And the pieces will be available right from NAFA, and thanks a lot again.
Thank you.